I want to get straight to the point, alright? How many of you have tried reversals and then you tried maybe entering like here, maybe enter here, and then you went like, oh crap, price action went against you, and you went in here and then flattened out, and then you went in and you kind of like don't have the courage to go back in over here. Okay, so in this video, I want to basically point out to you like why I've been emphasizing on MTF, multiple time frame, because on the multiple time frame you can see on a bigger picture what exactly is happening. So previous swings leave clues. After how many bars are we expecting certain amount of action? How much above the Ichimoku cloud did it go? How much below the Ichimoku cloud did it go? Are there any recent supports, any recent lows that we can possibly identify that could be a rebounding point for the markets? Okay, and then look at the Bollinger Bands. At this point of time, the bands are so narrow. Ask yourself, from your experiences, have you had more good experiences with wide Bollinger Bands or with narrow Bollinger Bands when trading a reversal? So in this video, I know I've like multiple sets of indicators. Why do I have it? Because in my previous video, I know there were some people commenting like, can I explain different choice of indicators? And I actually mentioned in my most recent blog post, this one here, go check it out, 9 fundamental truths about trading binary options. Go check that. I have a lot of tips for you guys about the various let's say strategy selection, time frames, all kinds of different stuff, so do check it out. But coming back to here, I want to basically point out to you how good markets and bad markets differ, and at the same time how one indicator can be good for a certain kind of a setup versus another. So as we all know, okay, Ichimoku cloud is good for runaway trades. What's a runaway? You have a long upslope or a long downslope and very clean. And when do these nice sloping price actions happen? Typically after the price has consolidated as close as possible to a straight line. So as you can see, I can even put a horizontal line here, and when it went up, ooh, went all the way down, and what you call a home run victory. But let's say if you were to trade this kind of scenario on a reversal, it is not the right kind of market, okay, for various reasons. The volatility is low, the MACD is very little movement, the swings are very short. Have a look, how many bars is it taking in between the swing up and the swing down? Have a count. Is that enough for you to win the trade? Maybe if you went in on this one, maybe it's enough. But the range is not very big, so would you have a clear victory? So would you be better off looking at something else where you had like a much wider bands? This on the other hand as well is not very good. But when we're still on this chart, I want to point out something to you. This chart, the Aussie CAD, the OTC right here, if you look at the 15, does that look nice? It's not bad, right? What about the previous swing? Does the previous swing give you information about how long it would take on the retrace? Yes, it does. So what would I possibly do in this case? This is a 5-second, this is a 15-second. So if I do typically a 1 minute on the 5-second, that's 12 bars. If I did 12 bars on the 15-second, that would be 30-second times 6. Round down, maybe I do a 1 minute 30. Would that be good? That would be reasonably good, wouldn't it? So I could do same approach over here, and then that would give me a lot more headspace for the trade. So but at the same time, coming back to my earlier point, there's something else, another thing to pay attention to these Bollinger Bands over here. The best kind of Bollinger Band reversal that we get is wide bands, like this, wide bands, and then we have like either an engulfing. This is an engulfing, so we have a bearish candle that is bigger than the green candle, and this signifies a change. Now, it actually went a little bit higher before it came down, and the ultimate point where it crossed down was a bit here. But would we have gone in earlier? There are several other things that are working well for us on this setup. There is the divergence on the ADX. which kind of works like an RSI sometimes, and the price. So this is going up, this is sloping up, this is sloping down, signifying a divergence. So in such cases, it means that even when it goes higher, it will definitely crash down. Now, there are other things to note. Okay, had you entered here, would that have been a bad thing? No. Why? Because we all know from my previous videos where I explained to you, when we take a ride and use navigation from, say, Google Maps or any map software, Garmin or whatever, the path to our destination is not always a straight line distance, and often it isn't. We often have to take different roads where there will be turns involved, and sometimes it could be going adjacent to our direction, it could be going opposite for a period of time, and then going in the correct direction again. So in this instance, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. And we finish off here, and still very nice. And effectively, we capture the biggest part of the movement. Now, looking at this other scenario, and I wanted to point out that something else can possibly happen as well. All right, what would the visualization of a bigger time frame reversal look like on the small time frame? When the price action has been very narrow, which I said is low percentage, we will see that manifesting as a constriction of the Bollinger Band around, like there'll be a price plateau, and then the Bollinger Bands would constrict around the price plateau, and then there would be some resistance to the upside that we're seeing right now is upside resistance. We may see some divergence as well. And divergence can be seen as, okay, like this is sloping up, but in the ADX diagram, it could be like a flat one instead. When it turns down, you can see that it's not the same degree of angle. Okay, the fact that this one has a rising angle tells me that it could potentially be one more additional wave. So in that way, we can actually spot that. And let's say over here we see a pin bar. If we take some entry here, could there be a possibility of another swing? There could be. So I'm not going to get too trigger happy with these kind of setups, and I also want to point out to you guys that this is not the kind of setups to spam click, because like I said before, throwing more money at a half-baked strategy or a half-baked entry is not going to improve your result. So this, I would say, is like a half-baked entry, because why? There's possibility for a further upward surge. And now coming back to the earlier point, when it does cross, when it does reverse, what we'll often see is that it will cross the middle Bollinger line. It failed to cross the middle Bollinger line here, and let's say if it closed at the line, we want to see a bar clearly closed beneath it. So we have 1, we have 2, and this closed clearly beneath it. So this would give us a better signal. But again, because the range is so small, it's going to be frustrating, and let's say this is much more appropriate for a higher time frame as well. So looking at the bars and movement, this is not actually the most ideal kind of setups that you want, and this is definitely not what you want to throw a lot of money at. Ironically, I did mention this in my most recent blog post too. I do expiry time. Okay, I do expiry time. Many traders have a fixation with time, and they think that the more they put on a trade, the longer expiry time should be to make it worth it. This is incorrect, highly incorrect. This trade, it took me a bit of time to find it. Like, I wanted to show you a good example versus like the various bad ones. Success leaves clues. I'm going to show you what clues this one leaves as opposed to what we've been looking at just now. As you know, the swings have been very large on this one, and it has been swinging almost like as if it's in a range. So what I mean by a range is that if I have like a pair of parallel channels here, we have this range of price action, and it's all within that zone. As opposed to, let's say if you were to trade like this one, yes, it's been very overextended, but like we also know that in the time that it took to go out there, the you know, if we had a parallel lines, it would be only so thin. So your turnaround would be equally very thin too, unless you're giving it a nice amount of expiry time. But why? Why take more time to do something that can be done in less time? It does not make it safer, and it does not give you less anxiety. It gives you more anxiety for more time, and there's also the risk of the trade plateauing out. Let's say if you're like, oh crap, I forgot it's lunchtime or something. Okay, my battery is running very low, so I hope this helps, and please do read my recent blog posts. You'll find a lot of wisdom that I've accumulated over 9 years of binary trading over here, so do check it out. And if you're not already signed up to my email newsletter, click on the link in the video description to be part of my newsletter to get all the great tips firsthand when they come out. Alright, thank you everyone for watching. Click the bell notifications button, and I really have to end this recording right now.